And good morning once again, options traders, and happy Monday. I hope everybody had a great weekend. And I just wanted to kick things off this week by talking a little bit about the danger of trading in the trough. That's just a trader's term when we start getting into periods of skews, especially when they're really high skews like we're having now during coronavirus. So remember, there are several types of skews. Very common one is called a vertical skew, where you've got various strikes, but you're looking at a given month. So it might be all of the October calls or all of the October puts or a combination of them. But those would be a vertical skew, or most of the time we just call it a regular skew. There's also a horizontal skew, sometimes called a tilt. It's the same idea in reverse. You're going to be looking at various months for a given strike. So maybe you're looking at all of the $50 calls, but for January, February, March, and so on. And what you'll find is that they will trade at different implied volatilities. So this creates a particular problem when traders are using spreads, not just verticals, but that's what I'm going to use for the example. Actually, skews can be a problem regardless of what you're trading, even if it's just an individual option. But again, if you're trading spreads, you can really step into some bad traps. So let's take a look at a vertical spread where you're going to buy one strike and sell another strike with the same expiration month. So for instance, you might buy the October 50-55 call spread. It would be a type of a vertical spread. The problem is that traders often sell the at-the-money options because they're the ones with the most time value or the most extrinsic value. There's certainly a lot of good arguments for selling the at-the-monies, but again, it presents a problem when skews are present. So for example, let's say we're looking at October strikes, and these are the 35, 40, and so on up to the 65 for a particular stock. And let's say that the stock is trading for 20% volatility. So this is the actual volatility that we can measure through standard deviation. Well, if that's true, then all of the strikes should also trade at 20%. After all, it's the same underlying stock for the same amount of time. Seems kind of odd that we would say that the 35 calls should trade at a different volatility than the 40 or the 45. So theoretically, you would expect if the stock is trading at 20% volatility, so are all of the strikes. So our graph should actually show up as a straight line. But in the real world, it rarely does that. We get what are called skews. So we might find that the 35 strike down here, let's say an in-the-money call or an out-of-the-money put, might be trading up here at an implied volatility of 30% or 40%. And then maybe the 40 is trading a little bit lower, 45 a little bit lower. The 50, if that's the at the money, is going to be real close to that of the underlying. There's actually what's called an arbitrage opportunity here. If the calls are a little heavy or if the puts are a little heavy, and that's what's going to keep the blue dot right here in line with this 20% line right here. So they're going to be almost touching, and that's actually what sets up part of the problem. And then beyond that, we might see the 55 trading at a higher vol, the 60 out this way, and then finally the 65. So this is what we call a volatility smile, for obvious reasons. It's a skew. So the problem is when traders start doing spreads, and especially vertical spreads, they might buy, let's say, the 45 and sell the 50. Why do they want to sell the 50? Because it's the at the money. They've been trained to sell the at the money because it has the most time value. But look what you're doing. You're buying the option with the high implied volatility and selling the option with the low implied volatility. This is what we call trading in the trough down here. This is the bottom of this wave, of this trough. And if you're trading in these areas, you can definitely step into some traps. Traders might buy the 55 and sell the 50, do a credit spread. Even though they think, oh, it's a credit spread, it's great, it's infallible. Not true. If you're buying the high IV and selling the low IV, you have a mathematical edge against you. Instead, these might be cases where you actually want to buy the at the money and sell a different one. Notice you're now buying the low implied volatility and selling a higher implied volatility. Or maybe you buy the 50 and sell the 60. But again, buying low, selling high. Alternatively, you might go in this direction. Buy the 50 call and sell the 40 call. That would be a credit spread, but at least you're buying the low implied volatility and selling the high implied volatility. So again, the point to make is that just because you've heard that you always sell the at-the-money option doesn't always apply. There are definitely times that it might be a good idea, and there are definitely times when it's a bad idea. And when it's a bad idea, or at least potentially a bad idea, is when you have severe skews like we have now during coronavirus. So remember to always consider your implied volatility. The at-the-money option may have the most time value, but it may have the lowest implied volatility, and that's what's most important. And if you're not taking that into account, you're going to be going in the opposite direction. So if you buy the high implied volatility and sell the low implied volatility, you've got an edge working against you, and that is the last thing you need during volatile markets. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.